in a world where you have more choices about where to invest your money than ever before. It's pretty confusing out there. There's a virtual infinity of ETFs, mutual funds, you name it. But more choice isn't always better. Sometimes having more options makes it impossible to decide which ones are right and which ones are dead wrong. And you've never had more options when it comes to picking exchange-traded funds and mutual funds than you do right now. They're everywhere. At this point, there are so many different kinds of ETFs that it can make your head spin. By the way, I hate the way many of the sector-based ETFs, the ones that let you buy and sell an entire group like the banks or home builders, have been warping the way the stock market trades itself. That's something you can, if you don't understand, you can read about and get rich carefully. Many are just flavor-of-the-month ETFs designed to cash in on something that's in the headlines. Fool you, frankly. All those silly FANG ETFs, the fintech jobbies, the ones that amalgamate cannabis, they're get-rich-quick instruments as far as I'm concerned, but only for the people who created them, not for you. But the important thing is this. You have all sorts of ETFs and mutual funds out there, and they can all advertise. They can. They're great at that. Companies that run these funds want your money. And one of your biggest mistakes you can make as an individual investor is to give it to them, with a few significant exceptions. Unfortunately, this is also one of the most common money mistakes out there. In fact, most people in this country simply equate investing with putting their money in mutual funds. Some 80 million people, or basically half the households in America, have exposure to mutual funds. Many of you don't have a choice. A lot of 401k plans don't let you pick individual stocks. I can't pick individual stocks, but it wouldn't have mattered because the 401k plan that I was involved in wouldn't let you. They just give you a menu of mutual funds to choose from, which is one major reason I think that all else equal, an individual retirement account or IRA is the better way to invest for you for retirement. Again, I'm restricted. I can't own stock. Mad Money is predicated on my experience and what I've seen all my investing life. If you have the time and the inclination, both are important, I believe that you can beat the S&P 500. I know because I've seen it done so many times in the past 4 decades by so many people I know. What exactly is so bad about mutual funds? Why am I railing against them right now? Simple. If you're investing in mutual funds, you're most likely, well, to put it delicately, let's say, but you're getting hosed. Why? See, my main beef here is with actively managed mutual funds. Mutual funds where there are people deciding which securities to buy or sell. Unlike hedge funds, mutual fund managers don't get paid for delivering performance. They collect fees from their investors, people like you. And the amount of money they make depends entirely on the size of their assets under management, which means the biggest incentive is not necessarily to do well, something that good performance can really help with. No, what they're really being paid to do is fundraise. And that's part of the reason why, in study after study, year after year, it's been shown that the vast majority of actively managed mutual funds underperform their benchmarks. It's a big reason why. In other words, if you invest in an actively managed fund for large-cap U.S. stocks, then its performance will maybe most likely fall short of the S&P 500. To make matters worse, despite consistently underperforming the market, actively managed mutual funds still have some of the highest fees in the business. It's counterintuitive. That's some industry. The hedge fund business is much more sink or swim. At my fund, we compounded 24% annually after all fees versus 8% for the S&P over the same period. Yet I fretted every second about fees and even chose not to take them during a year where I was up only a couple of percent versus a stronger performance for the averages. I was embarrassed. Did a mutual fund manager ever do that for you? You can read all about it in Confessions of a Street Addict. Might tell too much autobiography. Now, here's the part where I say not all actively managed mutual funds are bad. Some of them have fabulous records, okay? Some have fabulous managers who consistently deliver terrific results. But even here, there's a major problem. When a mutual fund delivers amazing results for a longer period of time, if the manager is a decent person, they'll stop accepting new investments. So a lot of these high-quality funds are out there, but they don't take new money because when your fund gets too big, it becomes incredibly difficult to beat the market. And if the manager's a not-so-great person, well, they'll keep taking in more and more money until their performance starts to suffer. When the late, great John Bogle, the father of the index fund, asked me how I could beat the averages so consistently when I was at my hedge fund, I said that I limited my investors and made it like a club where you had to be nominated to get in. That meant I was never overwhelmed with new money, something that often leads to bad investment decisions. Bogle said if everyone did that, they could have much better records, too. And maybe that was the real secret sauce of my hedge fund's multi-year outperformance. I know Jack Bogle thought it was. That's why, as a general rule, if you're going to invest in mutual funds, you don't want to be in an actively managed one. The fees are too high, and the evidence that the bulk of them underperform is too staggering. Plus, remember, if you're investing in a normal account, they'll inflict capital gains taxes on you, whereas you control when to pay, at least for the taxes, if you own your own stocks. Individual stocks, you don't have to sell them, you don't have to pay. If you don't have time to run your own portfolio, then I really want you to own a cheap, low-cost index fund that mirrors the S&P 500. This may sound like a real simple solution, but don't overthink it. The whole point of putting your money in a mutual fund is to save you the time and effort required to manage your own portfolio of stocks. That's why I think it's insane when people start owning multiple mutual funds. By its very nature, funds should be diversified. Now, I know there are a lot of sector-based mutual funds and ETFs out there, but there's really no reason for homeowners like you to have any exposure to those. I know it's counter. No one says this. I'm saying it. If you're going to take the time to try to play individual sectors, that time should be better spent really just picking individual stocks. As for ETFs, in most cases, these vehicles are for trading, not investing. Many ETFs rebalance every day, and that can take a real toll on any long-term performance. Of course, there are exceptions here, like the GLD, the ETF I like as a simple way to play gold. And I like the ETFs that mimic the S&P 500. But in general, if you're not a pro and you're not managing a portfolio of individual stocks, you should be very careful about fooling around with most of this stuff, especially those double and triple ones, leverage ones. Those are a nightmare. Don't do them. Here's the bottom line. At the end of the day, I think a cheap S&P 500 index fund is really the least bad way to passively manage your money, better than the vast bulk of actively managed mutual funds. But an index fund owns everything, the good, the bad, and the ugly. And if you do have the time to do your own homework, and again, there's that inclination factor, I believe you can beat the performance of an index by picking stocks yourself. If you don't have the time, though, don't overthink it. Just one cheap S&P 500 index fund is the best way to go. Let's go to Chris in Florida, please. Chris.
Hey, Jim. Quick question. I'm 35, and I have my 401k diversified across stock funds. What suggestions do you have to help better grow my retirement?
I want to keep things simple. Don't have a lot of funds. Make sure that you have the right amount of cash for a decline, and make sure you're getting a lot of income because you're going to need that because it's going to compound over time. But remember, you're diversified if you own a diversified fund. Don't feel like you need to be diversified by owning 3 diversified funds or 5 diversified funds. I've seen that far too often. Right? Sorry, not so mutual love here for mutual funds. Picking stocks is still the best way to manage your money, but if you don't have time or the inclination, I urge you to go with the cheap S&P 500 fund over most actively managed funds. Remember, I did not diss mutual funds if they have low fees, if they're S&P 500 mimics. Much more about Money Ahead, including how to find the best path to healthy retirement depending on your income. Then don't forget the kids. Protecting your children from student loan debt will put them in a better position to build a future. I'll help you plan for that hefty tuition bill. Plus, I'm responding to your tweets without the 140-character restriction. Well, they let them go longer. So stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.